Got to ask your thoughts. We saw kind of a relief rally at the end of the day after the president said that he's going to study the tariffs. And the soonest that we see him, at least from the Commerce Secretary pick, would be April 2nd, I believe, because the study's supposed to conclude on April 1st. So a lot to digest there. Also, the Indian trade deal. What do you think this means for the markets?
Look, I mean, I think the markets have figured out that discussions on tariffs are negotiation, and they're a means to an end. From the first Trump presidency, many of them, some of them were implemented, some of them were not implemented, but they were out there to get specific. They had specific end game in mind here, and I don't see anything that's different here. And I think that's what the market is really sniffing out here. What isn't talked enough about really is when you have a strong dollar that is an offset to some of the tariffs that are contemplated right now, and can blunt some of the real effect to companies. But, you know, there isn't a company that we've spoken to that isn't very cognizant of it and is very aware of it, which is why we think companies with more of a domestic focus are more insulated from
But
this.
I know you're not an economist, but I do have to ask you, isn't that a double-edged sword? Because the tariffs are also potentially going to make the dollar stronger. The dollar strengthens. That's bad for a lot of the big companies that actually drive the market.
Yeah, but they also have offsets, too, because they manufacture globally as well. So they do have some offsetting capabilities in terms of where they are jurisdictionally. But certainly you're seeing it in the lower margin companies that have to import various products, and certainly like the consumer staples types companies, those seem to be going through a more rough patch. But when you look at the global consumer branded companies, some of them are doing okay.
You know, it's funny you say that. You know, Kraft Heinz, obviously, you're talking consumer staples, a stock that was very hit, but we actually are seeing consumer staples surging. I'm looking right here. You're kind of leading me to my next question. Consumer staples up about 6.5% year to date. I actually think they were pretty close to hitting an all-time high yesterday. What does that mean when we're seeing investors go to what's a defensive sector if you're saying that tariffs aren't that big of a deal?
Well, let's put it in context. These stocks did very poorly last year. So there is a little bit of bouncing off of the bottom here, but you know, I don't think that that's really where the markets are really going to run to relative to the S&P. You know, those stocks really aren't, you know, significantly outperforming.
All right. To your point, J.P. Morgan on our air yesterday saying they're maintaining their 6,500 price target on the S&P. About a 5% rise from here. So not expecting a big rally, but also, and I thought this was interesting, saying they see 2 more cuts this year with the first one coming in June. Is that still meaningful for this market? I mean, we have earnings higher 15% year over year. Is it earnings or is it the Fed? What's the catalyst?
It's always about it's earnings first, and then it's clarity. What is the Federal Reserve going to do? Whether it's 1 or 2 cuts doesn't matter, but the market really needs to have some certainty of what that's going to be. I want to point out healthcare, which doesn't get enough talk right now. It's at a 10% weight in the S&P. That's a 25-year low for the index. So, you know, the setup is very similar to the way energy was in 2020, which had a huge year in 21 with a new president that was very anti-energy. You know, we're now going through some really difficult budget talks. These stocks have gotten really, really very, very inexpensive.